Welcome everybody to February. Hope everyone's, start of the year is going really well. You probably have heard, and what we'll address today is we'll kind of get right into it, is how the markets have been performing year to date. January was a bit rough, right? So we'll kind of talk about, performance there, tech stocks lagging a little bit, some indicators as we go throughout the year. And so Sean, talk to us a little bit about year-to-date performance, what the media is really honing on: Fed raising interest rate, creating a lot of fear, saying January was the worst month in performance since 2020, just creating a lot of fear in investors. And then kind of talk about what we've kind of addressed in conversations with clients that this first quarter is, what do we expect? What's going to happen? How does, the government, their policies, Russia, Ukraine, kind of the midterms coming up with some of those elections coming up in March. How does that all play a role in the markets, their performance, and what can we kind of gauge? What things can investors do for the rest of the year?
Yeah, so he kind of sums up with that intro. There's a lot going on, right? So yeah. Not only is everyone's New Year's diet probably over with, if you're like me, but so is also the good run in the markets. So the year of 2021 was a phenomenal year in the markets. Really capped off 3 extremely strong years from 19, 20, and 21 of U.S. markets performance, all averaging about 20%. So then all of a sudden we get hit in January, and everyone kind of gets kicked in the gut a little bit. And a lot of that's just because we got a little bit of a correction. But there's also a lot of things going on in the market. And Nora, yeah, you mentioned the Fed on the 26th of January released in their minutes that they anticipate starting to hike interest rates in March. And so the market started reacting a little bit negatively to that. But up until that point, we also didn't do so great. And I actually think that that will be a little bit of a good thing for the markets, because the markets like knowing information. So it's kind of, when were we going to raise interest rates? How much will we raise them? All that's still unknown. But I think January, we really started to price things in, because we saw the inflation number come out in January of being about 7% for the last 12 months. And so I want everyone to know that inflation actually tends to be a good thing. Okay, so the Fed targets a 2% inflation rate. And something people just don't understand is, why is inflation good? Inflation is good because ultimately we want to be doing really well at our jobs. We want to be progressing in society. We want to be adding more value to our companies, so our companies appreciate us, so they give us a raise. When we get that raise, we're going to go spend more money. And so as we get more money, we go spend money. The general rise in the price of all goods, inflation, starts to rise too. And a good healthy number that the Fed comes up with is about 2%. So that's why a 2% inflation number tends to be healthy, right? Because everyone's adding more value to society. When we see things like a 7% inflation number, and that number has just been creeping up higher and higher and higher, the Fed starts to say, okay, we need to kind of slow down some of the demand for goods. We need you guys to stop spending money. And so one of the ways that the Fed can do that is they can raise the interest rate, because I may have been really excited about buying a car or a boat or a house at 3%, but if you raise that up to 5%, maybe I'm not as excited to borrow money. And so that slows people down from buying things. Well, the same thing is true for companies. Especially companies that are really high growth. They've been borrowing money because they're doing research and development, they're hiring more people. It's a really good thing for them to borrow money until the interest rate rises. And so some companies that tend to be very growth focused are tech companies, which are represented really mostly in the NASDAQ index. So year to date so far, we've seen the NASDAQ down about 9.89%, the S&P down about 5.57%. through kind of the 7th of February thus far. So really not very good numbers, but you have to remember we're coming off of 3 phenomenal years in the US market. So it's just a little bit of a correction because we're knowing a little bit more information about what the Fed is doing. So we anticipate that volatility continues, because one thing we don't know is, how much does the Fed raise the interest rate in March? What does that look like? If it ends up being a bigger number than what the markets are priced in, we may say the markets continue to go south. If people say, oh, that's about what I thought, we kind of get some more information, the markets continue to do really well. One of the reasons that the Fed is saying that they're going to start to raise interest rates is because the underlying parts of the economy are really, really strong. We have extremely low unemployment. people have a lot more room on their credit cards than they did before COVID existed. So people paid down debt over time, which they tend to do when they're a little bit scared about the markets. They save a little bit more money, they pay down debt. Well, now they have that consumer spending kind of capability still on the table for them. And so as good Americans, right, we like to go fill those credit cards up, and we anticipate consumers continuing to spend. And all of those things will be really good for the economy. So low unemployment, a lot of room for consumer spending. We're starting to kind of understand COVID. We're not going to shut down again. People are going back to work. We're going to start to have the supply pick back up as we have less factories shut down for COVID. And so as all of those things happen, we think the economy is going to continue to be really strong, but we'll have a lot of kind of volatility as we kind of learn some information about how the Fed tries to really slow down some of the growth in the market. But that's kind of a lot of what's been happening here in January, a little bit of a correction, a lot more new information being pumped into the system. And I think ultimately, I think everyone should have confidence the underlying parts of the economy are still really, really strong. And we just kind of went through a little bit of a correction, and the market is starting to come back up really ever since the Fed made that announcement. And then, some of the geopolitical things that are happening, the Russia, Ukraine, China overflying Taiwan a lot. Right, we've got a lot of more information being put into the system that we start to see, are we going to have another two-front war? Will there be another war? How will that impact the markets? How will the global supply chain, the kind of global economics be impacted? I think all those things are being priced in, but none of it's really going to have a really large effect on it. Again, we've been through a lot of conflicts in the past. The markets continue to kind of truck on forward. So we think the market's going to continue to be really strong for the year, but just some of the information that's been coming in and some of the questions that we've been getting from people. And a lot of people are asking, do you think we're going to get, a change in the House in Congress? And I don't know that answer, right? All the polls are suggesting that there will be a switch, but there's a lot of time. We may see some legislation start to slow down now that we're in a midterm year. Usually that first year is pretty strong for the new president to come in, the new Congress to come in and kind of make changes. But now that we'll be re-electing a new Congress towards the end of this year, we may start to see some slower, rapid or drastic changes as people are trying to win those election seats. And so we don't know what that result will be, but maybe we start to see some tapering back of a lot of the spending or some of the drastic kind of changes in laws. But we may see things like that student loan forgiveness go through because they're trying to get a win before the election. So a lot of things that we're kind of monitoring throughout the year to see how the midterm elections play out. But that's kind of where the data is trending at this time. And those are really a lot of the questions we've getting. What are we going to see with the election results? What about the global conflicts? Are we worried about those? How about Fed interest rate? Hey, I opened up my monthly statement. It doesn't look as great as it did last year, right? What are we doing about that? Things that we continue to do is we want to buy things when they're discounted. So we've been spending cash in January. If there's extra cash in the portfolio, we want to put it to work and make sure we're buying assets while they're discounted so we can buy that dip.
Yeah, so Sean, you bring up a good point. You say buy when discounted. So I went to visit a bunch of friends this weekend, and I'm sure a lot of people listening, even at work, when you go there, people start talking, especially when you see a lot of volatility in the market. People are like, you got to sell this, you're a little late on this, you got to buy this. And as investors, fundamentally and academically, we're taught to buy low and sell high, right? But when you see this volatility and you see the markets dip, you're like, I got to get out, right? And so I've had a lot of questions or just conversations, buy this stock, sell this stock, better get out of this. And whether you're, an active or a passive investor, whether it's an individual stock or, maybe you have a portfolio of 100% equities or something like that, Sean, tell us as investors what, behaviorally we tend to do and how that really affects the long term. And a good example that we talk to a lot of clients about is what happened around, February, March 2020, when the S&P dipped, and what happened to investors if they pulled out.
Yeah, so, there's a lot of research that goes into kind of our philosophy, right? We call it an evidence-based approach. And so the research shows that retail investors or individuals that are playing around in their 401k or their own stock portfolio, we like to think that we're all rational, that we'll buy low and we'll sell high. But the data is overwhelmingly the opposite. People, when the markets are down, get a little bit scared and they start to sell. And they start selling low and they start locking in their losses. So the best thing that you can do right now is stay patient, right? Again, a really strong underlying economy behind what's going on. new information. If I have long-term dollars, I should stay invested. What we also are seeing is a lot of the retail investors, right, really made out in 2020. They got into the GameStop and some of the, kind of crazy positions. And now we're starting to see some of that optimism slow down because there's just a lot more uncertainty with everything that's going on. And so we're starting to see more institutional money start to be invested, right? Things like pension funds and hedge funds and financial advisors. People are starting to be more active now, again, because the underlying parts of the economy are strong, rather than just having some black swan event like a COVID kickoff. So retail investors tend to get really, really careless and start to lose when the markets are really volatile, both positive and negative swings. When the markets are all positive, they all feel really good about what they're doing. But when we start to see the market be volatile with big swings positively and negatively, their losses start to pile up and they start to panic a little bit and get out of the market. So what we want you to do is stay invested, make sure you're in a portfolio that you know and understand, ride out the wave, because the economy is really, really strong and we anticipate a lot of growth moving forward still.
Right. I think, Sean, that's all the conversations. Those really hit everything that's happened, this first month of the year, which is a lot. And so, that's what we have for our monthly market insight for this month. We'll touch back in beginning of March, but please, if you have any questions, send them over to Sean and I. Happy to have a conversation. Make sure that we tag it for next webinar.